Hey everyone, welcome back to Corporate Decoder, the place where we really peel back the fancy corporate jargon to see what's actually going on inside these companies. Today we're looking at an amendment to a report from the CALDWELL and ORKIN Funds Inc. And honestly, the reason they filed this amendment is kind of like finding a typo in a really important document after it's already been sent out. But hey, that's why we're here to decode it all for you. So what's the big deal? This is an amended filing for the Gator Capital Long-Short Fund. It seems like they originally reported some numbers that weren't quite right in their financial highlights, specifically related to the fund's performance over the last couple of years. They're correcting the total return and portfolio turnover rate from 2024 and the ratio of net investment income to average net assets for 2023. It's a bit like realizing you miscalculated your investment returns and then having to send out a correction. Now let's talk about how the fund actually did. For the year ending April 30th, 2025, the Gator Capital Long Short Fund saw an increase of 18.33%. That's pretty good. To put that in perspective, that means if you had invested $10,000, you would have gained about $1,000 during the same time. So they definitely outperformed the broader market. What helped them achieve this? The report highlights that their long positions in companies within the brokerage, capital markets, banking and insurance sectors were the main drivers of this outperformance. On the flip side, their short positions in banking, thrifts and real estate actually hurt their performance. Some of the stars of the show in terms of contributing to the fund's growth were Robinhood Markets, Barclays PLC, Interactive Brokers Global, Payments, Columbia Banking System, Hingham Institute of Savings and Wex Inc. were the biggest drags on performance. By the end of the reporting period, they had about 96% of their assets invested long and 20% invested short. This gives them a total exposure of 116% and a net exposure of 77%. This means they are quite active in their trading strategy, aiming to profit from both rising and falling markets. Let's look at the longer term picture too. The report gives us a decade of performance data starting from April 2015. This is where we can really see trends. If you invested $10,000 in the Gator Capital Long Short Fund back in April of 2015, you would now have about $22,483. That's a solid return of over 124% in 10 years, which works out to an average annual return of about 8.44% in 10 years, which works out to an average annual return of about 8.44% in 10 years. Which works out to an average annual return of about 8.44% in 10 years, which works out to an average annual return of about 8.44%. Now let's compare that to their benchmark, the Eureka Hedge Long Short Equities Hedge Fund Index. Over the same 10 years, that index grew from $10,000 to around $1,700 and outperformed this hedge fund index. And how did they do against the S&P 500? If you'd put $10,000 into the S&P 500 index 10 years ago, you'd now have a whopping $31,955. The S&P 500 had a stronger absolute return over the decade, with an average annual return of 12.32%. So while the Gator Fund beat its hedge fund peers, it lagged behind the broader market over the full 10-year period. This shows that sometimes focusing on specific sectors can lead to higher returns, but also opens you up to potentially missing out on the big gains from a broad market early. Digging into what the fund actually holds, we see a heavy concentration in banks making up 29.4% of their net assets. This is followed by wealth management at 15.2% and life insurance at 7.6%. They also have significant investments in consumer finance and diversified banks. On the other end of the spectrum, their exposure to smaller sectors like steel producers. Casinos and gaming and investment companies is much smaller. As of April 30th of 2025, the fund had total net assets of roughly $49.8 million. They held 86 different investments. The advisory fee, which is what they pay their investment manager, was about $43,525, and their portfolio turnover rate was 42%. A 42% turnover rate means they bought and sold about 42% of their holdings over the year, which is moderately active. One more notable point is that the fund's name changed from the CALDWELL and ORKIN Funds Inc. to the Gator Capital Long Short Fund. This happened on August 28th of 2024. Now for some of the more formal stuff, the fund states that it has adopted a code of ethics for its top executives. They also confirmed that no amendments were made to this code and no waivers were granted during the reporting period. This is standard practice for public companies, ensuring that their leaders maintain ethical standards. Regarding their audit committee, they mentioned that they do not have a designated audit committee financial expert. However, they feel confident that the committee as a whole possesses enough financial expertise to do its job effectively. Their auditors Tate, Weller and Baker LLT charged them $14,750 for audit fees in 2024. They also paid $20,755. They also paid $20,500 in 2024. They also paid $2,800 for tax preparation services in both years. Importantly, no other fees were charged by the auditors. This suggests a clean and straightforward relationship with their accounting firm, focused solely on the essential audit and tax work. This part of the finding is essentially the detailed financial report for the fund. It includes a schedule of all their investments, their statement of operations, which is like their income statement, and statements of changes in net assets. Let's dive into what they actually own. In the schedule of investments, we see common stocks as their largest category, making up about 90.72% of their long positions. The biggest chunk of this is in banks, which is 29.45% of the total net assets. We saw things like Axos Financial Bank of California and UMB Financial Corp listed here. They also hold preferred stocks and money market funds. On the short side, which is where they bet on a stock going down, they have positions primarily in banks too, accounting for about 8.95% of the net assets that they've shorted. They've taken short positions in companies like Bank of Hawaii, Capital, Federal, Financial, and New York Community Bancorp. Overall, their short positions represent about 25% of the fund's assets. Looking at the statement of assets and liabilities, as of April 30th, 2025, the fund had total assets of over $60 million. Their investments were valued at almost $49.2 million. On the liabilities side, they had about $10.3 million in liabilities, with a significant portion being money owed. For securities sold short, which was over $10.2 million, and for all that their net assets came in at about $49.8 million. After all that their net assets came in at about $49.8 million. The statement of operations shows their income and expenses for the year. They had investment income of over $1.4 million, primarily from dividends and interest. Their total expenses were just over $1.1 million, including advisory fees, legal administration, and audit costs. This resulted in a net investment income of about $282,000. The real gains came from their investments, though, with a net realized and unrealized gain of over $5.5 million. This led to a total increase in net assets from operations of nearly $5.8 million. The financial highlights table gives us a per share view of performance over 5 years. For the year ending April 30th, 2025, the net asset value per share was $48.41. Their total return for that year was 18.33%, which we already touched on. The ratio of net expenses to average net assets was 2.62%. This means for every dollar invested, about 2.62 cents went towards the fund's operating expenses. They also report a portfolio turnover rate of 42% for the year. This is a good place to quickly check key metrics like performance and costs. These notes provide crucial context and details. They explain that the fund's objective is long-term capital growth with a focus on capital preservation. They also detail the significant accounting policies and how securities are valued. One important note is the fund charges a 2% redemption fee for shares held less than 90 days. This is a common way for funds to discourage short-term trading and keep investors focused on the long term. This is the auditor's stamp of approval. Tate, Weller and Baker LL found that the financial statements present fairly the financial position and results of the Gator Capital Long-Short Fund. They've been auditing the fund since 1998. Finally, they provide information about the tax status of distributions. For you as an investor, this means knowing how your earnings from the fund will be taxed, whether it's considered qualified dividend income or eligible for other tax benefits. So what's my take on all this Gator Capital Long Short Fund is clearly trying to navigate a complex market. They've shown they can outperform in certain periods like the last year by picking strong positions in specific sectors, especially banks. However, their 10-year performance shows that while they're skilled selectors, they haven't quite managed to consistently beat the broader S&P 500, which is the ultimate benchmark for many investors. Their strategy involves taking on both long and short positions, meaning they're actively managing risk and opportunity, but this complexity can also lead to underperformance against Simple 500, which is the ultimate benchmark for many investors. Their strategy involves taking on both long and short positions, meaning they're actively managing risk and opportunity. But this complexity can also lead to underperformance against major indices over the long haul is something to keep an eye on. Alright, that's our breakdown of this filing. What do you think about the fund's strategy and its performance compared to the market? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate deep dives. And hey, join our Discord community linked in the description for even more insights and to chat with fellow corporate detectives. Thanks for watching, and we'll see you next time on Corporate Decoder.